In 2008, the entire global financial system almost ceased to exist. Not slowed down, not corrected, almost completely stopped. And the trigger? Millions of ordinary people borrowing money to buy houses they couldn't afford. Houses that banks knew they couldn't afford. Here's the insane part. The banks did it anyway, on purpose. If you've ever wondered why your parents lost their savings in 2008, or why the job market collapsed for a decade, or why governments started printing money like it was going out of fashion, this is the story behind all of it. If you have a pension, a retirement account, a mortgage, or you've ever applied for a loan, the 2008 crisis rewrote the rules of every single one of those things. You didn't just inherit the consequences, you're still living inside them. Michael Burry, a hedge fund manager who taught himself finance while studying medicine, spotted the entire collapse coming in 2005, 3 years before it happened. He read the actual mortgage documents, thousands of them, and what he found was so alarming, he bet his entire fund against the US housing market. He was right, and almost everyone else was catastrophically wrong.
Here is exactly how the financial loop worked. And once you see the loop, you can't unsee it. Start with a home buyer, maybe a school teacher, a factory worker, someone with an average income and a dream of owning a home. A bank offers them a mortgage, but not a normal one, an adjustable rate mortgage. The payments start low, almost suspiciously low for the first 2 years. Then they reset. Higher, sometimes much higher. The bank doesn't care if the buyer can actually afford year 3, because the bank doesn't plan to hold on to that loan. Here's the mechanism. The bank sells the mortgage to Wall Street. Wall Street bundles thousands of these mortgages together into a single financial product called a mortgage-backed security, an MBS. Now the risk isn't sitting with the original bank anymore. It's been packaged up and sold to investors around the world. Pension funds, insurance companies, sovereign wealth funds. But here's the red flag. These bundles were rated as safe investments. AAA rated, the highest possible grade by the same credit agencies. Moody's, S&P, that were being paid by the banks to rate them. That's not an accident. That's a conflict of interest so enormous it defies belief. So the loop runs like this. Banks issue risky mortgages, sell them to Wall Street. Wall Street bundles and rates them as safe. Global investors buy them. Banks get fresh capital. Banks issue more risky mortgages. Repeat, repeat, repeat. Everyone in the chain is making fees. Nobody in the chain is holding the actual risk. The risk just keeps moving further and further away from the people who created it until it's spread across the entire global financial system. And then housing prices stopped going up. That's all it took. Prices plateau in 2006. The adjustable rate mortgages reset. Homeowners who couldn't afford the new payments start defaulting. Foreclosures spike. House values drop. The mortgage-backed securities, which were only worth something, if homeowners kept paying, begin to implode. And this is where most people miss it. The banks themselves had bought these products. They thought they were safe too. Lehman Brothers was sitting on hundreds of billions in mortgage-related assets when it collapsed in September 2008. Not a small regional lender, one of the largest investment banks on earth, gone in a weekend.
Think about what that actually looked like on the ground. In Las Vegas, entire subdivisions were built on speculation. Homes sold, flipped, and resold within months, sometimes weeks, by people who had no intention of living in them. Prices doubled in 5 years, then they fell 60%. Or think about Bear Stearns. In July 2007, a full year before the official crash, 2 of their hedge funds that had invested entirely in mortgage-backed securities collapsed almost overnight. Their investors lost nearly everything. The fund managers had been telling clients everything was fine weeks before the implosion. Or consider Iceland, a country of 300,000 people. Its 3 major banks had borrowed 10 times Iceland's entire GDP to buy into global mortgage markets. When the crisis hit, the banking system failed completely. The currency collapsed. The government came close to bankruptcy. A country that had nothing to do with American housing policy nearly ceased to function. Because the risk had been so widely distributed, it reached everywhere, from a Las Vegas suburb to a fishing village in the North Atlantic. That's the scale of what a systemic financial loop, left unchecked, can do.
Here's what the numbers actually looked like when it was over. Nearly 9 million Americans lost their jobs between 2008 and 2009. U.S. household net worth dropped by $13 trillion, roughly 20% of everything American families had built. Housing prices fell 30% on average. The stock market dropped 50%. And globally, banks racked up an estimated $1 trillion in losses. The U.S. government stepped in with the Troubled Asset Relief Program, TARP, pumping $626 billion into the financial system to stop a complete collapse. By 2021, the Treasury had actually made a $109 billion profit on those loans, which tells you something interesting. The bailout wasn't charity. It was a calculated intervention in a system that was too interconnected to be allowed to fail. But here's the uncomfortable truth. The people who designed the system that failed were largely still in their positions afterwards. The banks paid fines, some were nationalized, almost nobody went to prison. The Dodd-Frank Act was passed in 2010 to reform financial regulation, but economists still debate whether it went far enough. So here's the question that doesn't have a clean answer. If every person in the chain, the home buyer, the mortgage broker, the bank, the ratings agency, the investor, was acting in their own rational self-interest, and the whole thing still collapsed catastrophically, is the problem the people, or is the problem the system that made all of those individual decisions feel perfectly reasonable? Think about that the next time someone tells you markets are self-correcting.